Good afternoon, ladies and gentlemen. Delighted that you could attend the second webinar held by the South African Lebanese Chamber of Commerce. It's a fairly exciting program. I'm going to kick off with a brief overview of the medium-term budget policy statement and the US presidential elections and consider their impact on the South African economy very briefly. Then what has become a regular feature and is intended to be a regular feature, a way of communication between the Lebanese authorities and our local Lebanese community, with a 10-minute broadcast by His Eminence, His Excellence, the Ambassador of Lebanon in South Africa, Mr. Kabalan Frangieh, followed by 15-minute presentations by Greg Saffy and Mark Kalil that I'll introduce you to afterwards, followed by question and answers. I'll kick off briefly with a medium-term budget policy statement. Obviously, it is a key element of the South African economic scene, in particular at the moment where the decline in economic growth of the past few months has resulted in a massive shortfall in government revenue, to the extent that in the medium-term budget policy statement, the shortfall in compared with what was budgeted for in February is no less than 313 billion rand. And the government's borrowing requirement is rocketing from an estimated 430 odd billion rand projected in February to around 775 billion rand, or around 16% of GDP at present. This is clearly an untenable situation, because with that massive increase in public debt, international investors are demanding a higher and higher premium through which to invest in South African government bonds, which are the vehicle through which the government finances that shortfall, that borrowing requirement. And with our long-term interest rates now higher than those of virtually any other emerging market, in fact, 6% on average above our inflation rate, the weight of having a high debt level on the South African economy is extremely severe and is crowding out its ability to spend, the government's ability to spend on everything else that is crucial, including things like education, healthcare, and policing. Now, the National Treasury came in to basically produce two scenarios. It did so in June and updated this now with a medium-term budget policy statement. In June, it introduced a supplementary budget because the figures had changed so dramatically as a result of COVID that it felt obliged to do so. Well, its most recent medium-term budget policy statement managed to retain the original budget deficits fairly close to what had been projected in June, but it is still a fairly alarming projection. We have the budget deficit to GDP ratio at 15.7% for this year, declining slightly to 10% and 8% in the next couple of years thereafter. But those figures, the shortfalls, are so huge compared with the projected growth rates, which is due to recover to around just over 3% next year, and then fall back to 2% and 1% the years thereafter, that if you're borrowing at the rate of 8, 10, 15% of GDP each year, there is no other outcome but that your debt levels soar. And that's exactly what is projected at the moment, with the base case scenario now seeing our public debt to GDP ratio peaking at 94% in 2025-26. And wait for it. That is the positive scenario. It is based on the assumption that the National Treasury is making of curtailing expenditure from 37% of GDP currently down to 32% of GDP in 3 years' time. How do we get there? Through a draconian cutback in expenditure on remuneration of public servants. For many years, there's been a criticism that our public servants are being overpaid, And they're insisting on getting big wage increases. But this latest budget says, the only way that we can actually even tame the public rising trajectory of the public debt to GDP is to restrain it to 94% of GDP by 2025 on the basis of limiting public sector remuneration to an average of 0.8% per year. In the face of an inflation rate of 4 to 4.5% per year over the next few years, that means a real decline in the living standards of public servants. Are they going to be happy with this? Clearly not. Are they going to agree to it? That is the big question. And so there is quite a lot of skepticism around whether or not the government can actually meet even this alarming fiscal target. And it is in regard to that skepticism that one awaits with bated breath the decision by ratings agencies in a few weeks' time to decide whether or not to downgrade South Africa's credit rating on a South African government bond still further deeper into junk status. We've been very fortunate, however, that our long-term interest rates have not soared in response to this alarming situation. In fact, in recent weeks, they have declined, mainly because of what has happened in America. Although the markets, I suppose, generally favored a Biden victory, the fact that Biden was unable to inflict as big a hiding on Trump as had been expected meant that we see that there is enough support for the Republican Party in the United States, and especially for Trumpian policies, to actually limit the extent to which Biden will be able to enact the measures that he has promised to do. And those include a reversal of Trump's huge tax cuts, an increase in regulation of financial markets, and a big expansion in the amount that the US government would spend on healthcare and infrastructure. And markets are actually quite pleased at the moment. They've got the best of both worlds. On the one hand, they're getting rid of what is regarded as almost lunatic Donald Trump. On the other hand, some of Trump's policies were not looked upon that adversely, especially the tax cuts and deregulation. And to the extent that the Senate is now likely to be in the Republican hands, there will be a check on the ability of Biden to introduce what many people would regard as socialist measures. And so this positive response on financial markets has fed through into a huge increase in the desire of international investors to buy the bonds of developing countries such as South Africa. And this has assisted in actually driving the rand stronger and driving our long-term interest rates lower, which helps reduce the potential debt servicing costs of the country to some extent. How long these positive trends are sustainable is open to question. We've had a huge positive feedback from the development of a vaccine by Pfizer that was announced last week, which has given the markets another big fillip, and the rand also keeping it quite strong. And there is a real chance now of a further interest rate cut when the Reserve Bank Monetary Policy Committee meets again next week. So I've given you the good and the bad. I leave it for you to judge how South Africa will be able to cope with this alarming increase in its debt levels, and will it be able to introduce measures that will actually limit the improve economic growth so as to increase tax revenues in the future, and in so doing help limit the increase in that debt. I leave it to you to judge. Cynics will argue, especially given the tensions within the ruling party, the ANC, that they remain skeptical of whether we'll achieve this. But fortunately, we do have a more positive international environment that is limiting the damage that might otherwise have been inflicted. Now, it's very interesting because the one country that South Africa features fairly favorably in comparison with in terms of forecasts of what's going to happen in terms of economic growth and debt levels is our own dear Lebanon. And to get an update on the Lebanese situation, I would now have great pleasure in introducing His Excellency Mr. Kabalan Frangieh, Ambassador of Lebanon to South Africa, to give us an update on the Lebanese situation. And I mean, for me, this is really the novel issue and the important input that we gain from these webinars as a Southern African Lebanese Chamber of Commerce. Thank you very much, Mr. Ambassador, and I pass the floor over to yourself.
Thank you very much, Azar, for introducing me, and thank you for the board for organizing the second webinar. I think those are very fruitful interactions, and I'm very grateful for the chance to be able to address everyone participating. Actually, you gave us the good and the bad. Azar, I'm going to do the same, although my job as an ambassador is usually to give the good. But for the sake of transparency, I would rather give the real image now so that everyone gets acquainted with the latest developments in Lebanon. As you all know, we have a French initiative on the table. The French initiative kicked off just before the explosion of 4th of August, which was devastating, which was, I think, one of the hardest experiences that the Lebanese people had to go through, even worse than civil war's time. And we are still suffering because of this. The morals of our people are not high. We are going through tough times. And there is a French initiative on the table, which we call like a vision for a government or mission government. They're speaking about a government for 6 months, which will do reforms, starting with some forensic auditing to see where is really the hole in the financial model in Lebanon and in our institutions. In this initiative, there are very serious and promising reforms that should kick off once the government is formed. Some of them are related to the energy sector. Others are related to our the whole financial system that is in place, merging of banks, and revisiting of the whole economic model, but in phases. Within the points of the French initiative is to also open the way for the IMF to intervene in the economic situation, to push the negotiations forward with regard to possible privatization of some sectors, increase in the VAT, a decrease in the public sector, and many other similar issues. But what's at stake in Lebanon is not only that. This is a 6-month mission to put things back on track. Some people are speaking of more deeper reforms that will probably affect the whole political system, the whole setup that has been formed after the civil war in 1990. So a new social pact or political pact. Lots of talk about how, what is the best way to move forward, given that the financial and the economic model that was in Lebanon needs restructuring and a reset and reforms, call it the way you want, but it's a given now. All political parties and everyone agrees that we should have this reset, which is a positive sign. And having said that, there are lots of ways that nature does not like void. Lots of new ways that the Lebanese economy is refining itself, is reinventing itself. we can see that even though the model need revisiting, whether it's the banking sector or that is the main pillar of the Lebanese economy, or the whole taxes and interest rates. Taxes were low in Lebanon, interest rates were high. We are talking about a new economy that is starting to shape itself. We are seeing growth in the IT in Lebanon. We are seeing growth in everything related to design. The economy is creating jobs in those two sectors. We are seeing a growth in agro industries, local production. Import is on a historical low. Dollars are not going out of the country anymore because there are not many dollars in the country. So the economy is which is very interesting and in a very fast manner, is starting to let's say open new doors and is creating jobs in terms of food, pharmaceutical, all those sectors that are must, all those sectors that usually were needing dollars from the government to import medicine or medical equipment or food. We are moving into production now, which is a very promising field, given that it's mostly on FDIs, given that the banks are not giving loans in Lebanon. So FDIs are the only, we call it fresh money now, not FDIs technically, because of the, as you all know, money is stuck in the bank. So it's only money from outside that is able to create new like SMEs and new small companies. And sanitation is booming. We would be surprised how even though we had a sector which was historically a big myth, and the whole Lebanese economy was built on a vibrant banking sector, now we see that even though that this is paralyzed, there is a legal parallel economy that is working very well and starting to working very well. And lots of immigrants are participating in it. Lots of people. One of them is the cousin of Garth. His name is Kevin Towell from the States. He's opening a new IT company in Lebanon. The cost of labor is cheaper. The cost of living is cheaper. Of course, exports are cheaper. Visitors, I mean, used to pay, like, for example, 5 times more during a week than they pay now. Of course, not to mention that we have now Covet, and we're still in this pandemic. And even though there is a possibility of a breakthrough in terms of finding vaccines, but Lebanon is not doing as well as South Africa as we speak in COVID. The whole area, Jordan, Palestine, all of the surrounding countries, we are following Europe in that. So this is a parenthesis. This will pass, but we see that the Lebanese economy is undergoing a new automatic restructuring alone, because the private sector in Lebanon has always been the one, let's say, connecting the dots. Even though the region is not well, even though we have problems in war in Syria, problems in the whole area, the Arab world is divided, but the Lebanese private sector is everywhere, has a good view of the markets, and we were surprised, and I have names of companies in the sectors I mentioned that are investing now as we speak in Lebanon during all those crises that we are living, because this is probably a time where the return on investment is high. And the private sector in Lebanon is finding partners and is finding ways to fill the gap and the void, and we are positively surprised now. Nothing can be complete unless we have a government. We have to put things on track. We need security for an economy to to be able to be revived. We are not talking of a revival between 2-3 years to 4 years, maybe 5, but given our history, I mean, all the signs are there that the economy will be back on track much faster, because the economy in Lebanon is very elastic, because the private sector is the one leading. I think we will be recovering in a much faster pace than lots of people expect, lots of analysts expect, and lots of, compared to many other countries who have been in this kind of problem, whether we're talking about Argentina, Greece, or Cyprus, to name a few. So I can say that the situation is good. It's difficult, but it's not as bad as it could have been. So let me put it that way. Let's hope that these few months pass. Internationally, Lebanon is always affected by the developments, whether it's the American elections or international markets. We are connected and negatively or positively affected. So this is a waiting time. This is a transition. And as you mentioned, Azar, the markets are not feeling, are not very depressed, let's say, they did not as expected. People were expecting that there would be more uncertainty. So this is good. But politically, the uncertainty is still there. Whether Iran will have a deal with the United States, it remains to be seen. People speak about that. People speak about what will be reversed, what will not be reversed by the new American administration. So there is lots of uncertainty that I think all the region will be waiting to see, or will be affected in this case or the other. I don't want to take more time. I'm grateful for the opportunity. And I will have to apologize because I have another meeting and I have to go. I could stay for a while, but I can't stay for the whole webinar. Thank you very much. We can't hear you, Azar.
Mr. Ambassador, I'd like to thank you so much. I've personally found it very encouraging to see that amidst all the turmoil in Lebanon, we see the Lebanese spirit of entrepreneurship starting to rise at a time when it desperately needs to. It's a message that I think needs to be conveyed here in South Africa as well. Would that we had the same entrepreneurial capacity in our country here in South Africa to emulate what the Lebanese are doing. I think the sky would be the limit. Skies would be the limit here in South Africa. And I'm really encouraged to hear that. And I believe it because I have seen the way in which our compatriots behave, that fundamental, from the time of the Phoenicians, this fundamental spirit of entrepreneurship coming through the fore. Thank you so much for that, and we're very grateful, and we wish you well. If we don't have another webinar before Christmas, I'm sure everyone will wish you very well over that.
Thank you, Azar.
Thank you. I'd now like to pass the baton on to Greg Saffy, and I am very excited by this because here we have one of the younger Lebanese coming to the fore and succeeding in the marketplace, having made a name for himself as a rated analyst in the banking sector. Greg Saffy established CIC Iron Curtain back in 2014 and has made a great success in identifying opportunities for investment. So let me not take any more time. Greg, I pass. We're very excited to listen to your presentation and to get ideas from it. Thank you.
Thanks. Thank you very much, Azar. Yeah, so when constructing global portfolios, the approach that we use is a top-down and bottom-up approach. So to look at the macros, look at the sectors as a consequence of the macros, so the ones that we would favor in a certain environment, and then stock picking. Currently, the three main factors that are taking up the majority of our time and that we focused on in this environment is the pandemic, the impact it's had on global economic activity, global stimulus. I'll then touch on some of the key outputs when looking at these factors, and then finally our global and local positioning. So if you just turn to the pandemic, a quick snapshot, currently at the time of writing anyway, there were about 50 million infections, 1.2 million related deaths. Interestingly, this pales into insignificance when you compare it to other pandemics that have happened historically. So you'll see anywhere sort of from 500 to 800 million infections. Thankfully, death rates have actually are much lower, about 1.4%, and that's as a consequence of many things. So whether it's better treatment of the virus, a better understanding of the virus, and then this issue of what people term dry powder when this virus initially broke out. So it unfortunately had a significant impact on the more vulnerable. That said, the issues that we focus on from an economic and financial perspective has been the consequences of government interaction and or reaction and regulation, and that's in the form of lockdowns. So very simply put, inactivity equals less economic activity, more mobility equals more economic activity. So to date, there's about 57 odd vaccines in various phases. And notwithstanding this news that we've seen recently from Pfizer, there actually hasn't been one single vaccine approved, and that's certainly from the FDA. The issues, just in terms of rolling this vaccine out are pretty severe. So it's pretty well known that should a vaccine actually be approved, it will probably take somewhere between 2 to 3 years to meet global demand. That said, even if there is a vaccine, the problem that we have is that the long-lasting psychological impact, certainly on certain sectors, will be pretty pronounced, and this is what we call the scarring. So things like people's willingness to go to things like concerts or sports events and restaurants and pubs will not be sort of a quick fix. It will not be a quick fix solution. Okay, so if we look at the sort of second factor, we've gone to the steepest and deepest contraction since the Great Depression, in fact, actually on record. But all of that said, recently we have seen activity levels actually starting to improve. And there's an interesting little chart over here, and what it shows you is just global mobility, and that's highly correlated to a return in economic activity, as evidenced by the global PMIs or manufacturing indices. So if I just turn to where our sort of global economists, so we follow two. There's a lady by the name of Professor Gopal from the IMF, and this particular chart actually comes from the OECD. This is the latest September update. So global economists are basically looking for economic activity to return to a pre-pandemic level by Q4 2021. Importantly, though, this comes with a high degree of forecasting risk and will actually largely be dependent on, one, a vaccine, and two, further waves and whether it's the second or third wave, and and global governments' reactions to these particular waves, i.e. lockdowns. But the bottom line is consensus forecast return to economic levels last seen in January 2020, by 2019 to Q4 2021, but with a significant amount of downside risk. And then the third issue has really been global stimulus. So there was a coordinated or synchronized reaction by global central banks. 45 of them cut rates simultaneously. They intervened in the bond markets, intervened in the FX markets. They've been doing specific bond buybacks. They've been writing out stimulus checks to individuals. So it's come in the shape it's come in the shape and form of many different forms. Interestingly, the largest amount of stimulus has actually come from countries like the UK, the US, and Japan. So that's on sort of top right, and they've spent as much as 10 to 12% of GDP. I think if you just look at it globally, they've pumped in over almost $20 trillion worth of stimulus into the system. This, of course, had a marked impact on interest rates, particularly long bonds. So, what it did do is it greased the financial wheels. Interest rates were cut dramatically, so very difficult for us to actually find a yield anywhere for individuals overseas. It also had the unintended consequences of creating certain asset bubbles in certain sectors, and certainly things like big US tech, we've seen it, and in areas like international corporate credit. From an economic perspective, what does worry us is if you do withdraw stimulus now too early before economic activity is actually recovers, that could have quite severe economic consequences, and certainly quite severe consequences or impacts on your on the equity markets. So, from all of that, what are the sort of key outputs that we look at? We think that the economic recovery will be uneven when you look at it by country. We prefer the US for a whole heap of reasons. They were the one country that got out of the great financial crisis sooner, well, in fact, the earliest. So they dealt with the issues and dealt with it quickly. Within economies, so take the US, certain sectors will recover unevenly, so it will be an uneven economic recovery. We think that there will be long-term scarring effects, so certain sectors we think that will be impacted by social distancing, we are certainly staying away from. And then I suppose the last point is, it's again very difficult to find risk-adjusted income or yield, when you look for yield for clients offshore. So you put your money in a bank account, you get almost next to nothing. 65% of sovereign debt globally trades at negative yields. You've got offshore corporate credit, that's investment grade credit that trades at sort of 1.5% to 2%. Pre the pandemic, used to get 3 to 3.5% for 10 to 15-year money. So, for us, that certainly does, present quite a big challenge. So how have we positioned our portfolios globally? We focus on US mega caps. So if people come to me and they go, Greg, try and find the next Google, that's certainly not what we do. But we are investors in the likes of a Google and Apple and Amazon. We do like the US mega caps, particularly those that are not impacted by social distancing, have strong balance sheets, very strong cash flows, good ROEs, and have got significant moats. And we've had at least the benefit of seeing these companies report over the worst of the financial crisis, over the worst of this lockdown crisis, and they've actually come through relatively well. Balance sheets is also one thing that we do focus on. In an all equity portfolio, that said, we are still very defensive. Bonds make up about 40% of our total holding. Now, the interesting thing is, we do try and look for risk-adjusted return. So the two names that we've invested in, interestingly, was at the height of the liquidity squeeze. We went and invested in US government bonds. SA government bonds listed in the US. And we got clients somewhere between 6 to 7% in US dollars for 10 to 12-year money. And then we've invested in a single name, which is Sasol, which is what they call a self-help story. We don't think that Sasol is going to go insolvent for a number of reasons. And we managed to pick up, that credit at about 9.5% US dollar yield for 8-year money. Yeah, and as I said, I mean, very difficult to actually go and put clients into US treasuries that are sort of giving you 70 basis points for 10-year money. We've kept cash aside, and that's ready for dry powder, so you earn nothing offshore. So that's ready to put to work what they call opportunistically. We've got 5% holding in property, so we cut a lot of our property holdings, particularly those shares that were exposed to social distancing, which has been office and retail. And we own names like, an interesting little one is US Postal Service, which is 100% occupied it's 100% occupied by the US Postal Service. They haven't missed a payment. You've got 3 to 5% incremental rent reversions that's up, and there is a sort of a consolidation story happening there. So property that really isn't sort of majorly affected by social distancing. 30% of our holding sits in tech and healthcare, but at this current level, it's mainly healthcare. Into US pharma ETFs, into things like Boston Scientific, Medtronic, Stryker. Those are sort of the names that come to mind. United Healthcare, which is a sort of a Discovery Life on steroids. And then we've marginally been we own marginal names in the likes of an Amazon and Alibaba at 10 cents. So the sort of the big US mega caps. 15% we sit in defensives, and that's things like tobacco, British American tobacco, so trading on 8% yields. Again, not really sort of impacted by this pandemic. Companies like Procter & Gamble and Nestle have actually done very well in this crisis. So as people have moved away from restaurants to actually eating in. And then we've got sort of a minimal amount in cyclicals. And those are actually largely through the likes of Anglo American because of our preference for platinum. So, to give you some sort of sense, very defensive. We've gone a bit asymmetric just in terms of the bond allocation to try and get what we would see as risk-adjusted returns, as opposed to sitting with 1% or 2% in long-dated US corporate debt. And then largely in names that at the moment are still not directly exposed to social distancing. And then finally, if we look at our sort of local portfolios, we've been heavily overweight SA bonds. We think getting 10 to 11% at one stage for 12-year money was a very good bet. We've got some of the steepest yield curves in the world. We've got some of the largest credit risk spreads in the world. And so whilst there are concerns, obviously from a fiscal perspective, we think that people are getting well compensated for it, particularly given the fact that you can only get like about 3.5% if you got your money in cash, which are short-term rates are sitting almost at 1974 lows. We do like bank prefs. That's about 20% of our portfolio. These are instruments that will give you between 9.5% to actually 11.5%, and is in the form of a dividend and is really sort of driven by short-term rates. So you're getting a very good yield after tax, particularly when you look at what you can actually get in the bank account. And these are prefs that are largely issued by the banks. We're pretty comfortable that the banks will be profitable, even though they will continue at a lower level of profitability, simply because mainly as a consequence of lower rates, lower activity, that's lower interest rates, lower levels of activity, and higher bad debts, the reality is that these banks will still be largely profitable. We hold about 10% in cash, and again, that's largely dry ammunition. 5% in property. We've had to cut that back quite dramatically, and we're pretty comfortable with a minimal holding. And then 25% in equities. And again, much like the international portfolios, we've picked names, the likes of a Spar and an Aspen, a multi-choice group, a Coronation Fund Manager, MTN. You know, these are companies that have been marginal beneficiaries actually of this pandemic. They've had actually very solid results, comfortable with the balance sheets, and produced you know, fair amounts of cash and returns, you know, through this crisis period. So it's largely, I guess, some level of sort of a thematic overlay, but more importantly, sort of stock picking. So yeah, I mean, hopefully that gives you sort of an overall view of how we've sort of managing portfolios through this crisis. Yeah, that's it, pretty much it from me.
Thank you. That was great. Thank you, Greg. It's so nice to be able to just talk about the market performance sitting next to Greg, because from a market performance point of view, working with an asset manager with a balanced mandate, you actually see what's happening on the ground. So this is COVID, investing in turbulent times. What a week to talk about this. We've had record highs across the equity markets. We had the news of Pfizer coming out on Monday saying that there's positive results, 90% positive to vaccine trials. You've had oil moving up 15%. That's a leading indicator for global growth picking up. And then yesterday on the JSE, you basically had double the volumes coming through. And it happened yesterday in a bull market, outclipsing the volumes that happened in COVID during March. So we will be looking across asset class as to what has happened in the world markets. And again, it's very turbulent. We're going to look at the COVID crash versus previous market crashes. We looked at this in July. This is updated. The COVID crash is very, very different to the other market crashes. We've talked about this before. In 2000, the dot-com crisis crashed 49% from its peak to its low, and it took 2.5 years to go from its peak to low. It then took 6 years to pass its pre-crash high. The global financial crisis took 1.5 years to dip into its bear market, and it took 8 years to pass its high. When we look at COVID, it's been amazing. Within 1 month, it fell 34%, but within 6 months, it's actually passed its pre-crisis high. So this has been the shortest bear market in history. In the USA, the S&P 500, 5 months to pass its pre-crisis high, and all of these were followed by record highs in global bourses within 6 months. You haven't seen this before. Last time we talked about an event timeline. It was well received, so I'm going to continue from the second half of the year. We're going to be looking at record highs in the third quarter, then the second wave in October, which had a devastating effect on the markets, and then a positive outlook for 2021. Into the third quarter, economies reopened. The Federal Reserve, like Greg said, are keeping rates near zero. So where do you put your money? Into equities. Economic recovery in the third quarter USA, it was a record GDP growth. We're still waiting for South Africa to talk about their third quarter numbers. Greg mentioned the low yields globally on bonds. It's record low. In Ghana, you can't even get 0.5% on shorter dated T-bills. So equities, once again, in the third quarter was your star performer, led, like Greg said, by your US large cap stocks. We talk about FANG, Facebook, Amazon, Apple, Netflix, and Google. There has been continued foreign flow into US stocks. If you look at the table on the bottom right, in yellow, the S&P 500 has moved up to around the 3,500 level. And in blue, that's your foreign investment into US stocks. Currently, 16% of the S&P 500 is held by foreigners. About $200 billion has gone into the market this year.
So NASDAQ hit a record high, S&P 500 record high, risk on for emerging markets. And on the equity and debt capital market side, that's new corporates coming into the market to raise money, very positive. So it was a good third quarter. All of a sudden, enter the tsunami, the second wave. Things are red, the emergence of the second wave, lockdowns in Europe. This unnerved the market. Risk off immediately in October. Volatility rose, that's displayed in your VIX index, we call it. Your dollar firmed against all your major currencies, even against the rand. You had pre-election and jitters and UK Brexit uncertainty. So equities fell in October. We saw profit taking on the golds, which was your star outperform in the second quarter. They talk about Robinhood trading platform, the man in the street, everybody's jobbing, getting in and out just to own US stocks, ETFs we call it, and there was this consolidation. Energy shares fell, oil fell, Sasol, the equity dropped from 140 to 70 Rand, real estate stocks fell. All of a sudden you had this massive market consolidation and the world was looking for direction. Direction came in the form of last week, Monday, the US elections. That was on Tuesday, but last Thursday you had the FOMC meeting. They said we need more fiscal stimulus. They said the virus is impacting the economy and they need cash. The US elections came through. And immediately last week, we saw the NASDAQ up 10%, S&P 500 up 9%. Greg's positioned into the US techs and healthcare. Those seemingly are leading the markets. Emerging market is favored over US stocks. The market believes that Biden will have stronger relationships with China. That'll be good for trade with emerging markets. We wake up on Monday morning and we had a silver lining. Positive vaccine results from Pfizer, hopes of boosting economic growth. All of a sudden you saw a rally in your cyclicals and value stocks. It was amazing that Warren Buffett in one day made $10 billion. On Monday alone, Bank of America went up 10%, that was a financial. American Express 20%, that was an industrial, and Coca-Cola up 6%, a consumer stock. He calls these real economy stocks. So all of a sudden, you've got hope that the market's not just going to be led by techs, but by real economy stocks. Pharmaceuticals moving up. We saw rotation away from your US techs. Oil rallied, gold fell, and all of a sudden, we've got a positive outlook for 2021. That ties up the event timeline. I'm just going to run through the asset classes briefly, 2 or 3 themes on each. Firstly, US equity performance. You guys will get this presentation. From July to October, 4 months, the market was led by your US large techs, like we said. The market was waiting for recovery on your battered stocks. Equities outperformed bonds. If we look on the bottom left, US equities, a stock like Tesla moved from $50 up to $500 from March to October. It's got a forward PE of 650 times. It's crazy, but it came out with good earnings, and all of a sudden your forward PE is 100 times. That's basically saying this name has to grow at 3 times the valuation of other companies like Google and Microsoft to make back your money, but they are getting the earnings. So your US techs have been driving this market. Banks like JP Morgan down 30% year to date, waiting for recovery until we got the Pfizer news. And you look at South Africa on the right, you've basically had outperformance from Naspers and Prosus, which is its international internet business. So those are getting international revenues, they rand hedges. It's basically distorting your South African market, which is dominated by resources and consumer goods. So at this stage, USA outperformed South Africa. If we look at South Africa between July and October, the market was dominated by platinum. And if you can look at the table on the left, which I've highlighted in yellow,
we started to see evidence of the retailers, the banks, and the beverages starting to move into positive territory, which was encouraging. These were, again, your lockdown affected stocks, and it was good to see that we started having some semblance of investor appetite. What wasn't good to see is travel and leisure was down 16% and real estate down 20%. Year to date, they were both still down about 60%. Those are your hotels, hospitality, travel, property companies. And until this week, those were the laggards. So that's basically what pulled down our sector. If you look at the bottom right, the outperformers in the last 4 months were your platinum and your gold fields. But again, good to see in the third quarter for Sheeny, ShopRite, Discovery, Spar, Mediclinic, all of these value and cyclical, we can say, stocks starting to come right and show evidence of recovery. On the negative side and underperformance, Fortress, Redefine, your property stocks and the industrials were the laggards. If we look at the Rand, very encouraging. On Monday alone, the Rand dropped from 15.75 to 15.25, eclipsing our year-end target. When we chatted in July, we spoke about these positive technicals. We also said it had a positive year-end target for 15.50. What's happening? The key three themes, it's very volatile. There's been low offshore participation into your Rand. So at this stage, spreads are wide. It's been very volatile. SocGen on Monday said that they're optimistic that the Rand can get to 13.87 by March next year. Also with Biden coming in and the flavor for emerging market, you would expect any global recovery to benefit your commodity producers. So emerging market, all of a sudden your Rand, Canadian dollar, New Zealand dollar, Aussie dollar come into play, and it's very positive for those. If we look at the table on the bottom right, the Rand is down 9% year to date. It is still underperforming the likes of your Far Eastern currencies. But if you look at the chart on the left, technically bullish, good signs ahead. If we look at the South African bonds, already been mentioned, the impact from the medium-term budget by Azar and by Greg, who's fully invested 40% of his portfolio in SA bonds, it sounds like. It's a positive story. The medium-term budget was generally positive for the Rand and for bonds. We have seen stabilization of bond markets. If you look in the table, the snapshot, in March, we talked about this large injection of cash into the bond markets. We saw foreign selling, local selling. The auctions were undersubscribed. There was this fear, contagion of the COVID impact, and the bonds were illiquid. Fast forward, fast track to now, market stabilization. The locals are buying, strong subscription, liquidity is still thin. What is a bit concerning, bottom left, year to date, your foreigners have been net sellers of SA bonds, 50 billion Rand year to date, and equities, 100 billion Rand. When we presented on the last webinar, equities was minus 50 billion Rand. So in the second half of the year, it's been your foreigners selling your South African equities through the Rand. If this turns around, you should see positive performance all around. Last thing to mention on this page is your South African government curve. Like Greg mentioned, it was steep. We're starting to see a word called bull flattening. People are buying in your 10 to 15-year buckets, and that's starting to come down. So people have recognized the benefit of buying the higher yielding South African bonds. We get on to spot gold. Spot gold. Sorry. I'll get rid of it. Sorry, I don't know if you can see that. Spot gold was the outperformer in the second quarter of the year. Sorry, I don't know if you can see the screen. Spot gold was up 25% before COVID at the end of last year. During COVID, it moved up 28%. It hit a record high of 2060. Before Monday, it was at $19.50 an ounce and dropped 5% to $18.50. The positives right now, technically it's still poised for a breakout on the upside. However, the futures market is basically saying that there's uncertainty it might come down. ETFs, you buy access to gold almost like a stock. For 10 months in a row, there have been net inflows from the man on the street getting access to gold. It was so large that in the first half of the year, the flow into ETFs was about 50% of your first half gold production. That's how many people are sitting in gold and they believe it'll go higher. With what's happened now, the certainty that there may be global recovery, this could be sold off, and this is a space to watch in the next couple of weeks. Finally, on crude oil moved up 14% this week alone on the back of the vaccine results. OPEC is having a meeting on the 1st of December. And at this stage, because oil has moved higher, there's less pressure on them. The important thing here is to talk about Libya and Iraq. Libya were in civil war. They need money to get revenue in, and they've been using fourth quarter stockpiles to sell oil in contravention to the agreement just to get in cash. Iraq is in economic crisis. They can't even pay their public servants at this stage, and they need to sell oil. So OPEC this week, Saudi Arabia said that they will work and manage and balance the market with the likes of supply coming out of Iraq and Libya. So it's cooperation. You've had this recovery. There's evidence that global markets are picking up. And at this stage, everything looks like it could be a bit more positive than it was a couple of months ago. A Wall Street quote to finish: the big money in trading comes not in buying and selling and jobbing, but in waiting. So with balanced mandate, with hopes of recovery, with the anticipation of foreigners coming back into our South African market, which would be a key driver next year, it's going to be crucial just to be patient, possibly pick up value stocks, and South Africa should outperform along with emerging markets if we do get global recovery in the next couple of years. Thank you.
Thank you so much, Mark, for a fascinating presentation and quite thought-provoking, talking about South African prospects being superior to those elsewhere, and potential gains. I'd like to open it up to the floor for any questions that either Mark or Greg might be happy to respond to.
We just have one last question. Should the international community consider investing in Lebanon right now?
It's wonderful to invest at the bottom, isn't it?
I'm going to pass on that one, Mark.
I was so encouraged by what the ambassador said. Knowing what the spirit of the Lebanese is, I actually think that, and the ambassador actually mentioned it, there's an opportunity to make very high returns if you get it right at the moment. I would have thought that you could be buying at the bottom. For people who've got spare cash and want to take a punt, I think it's as good as any, actually, if you can pick the right winners. And what I found so exciting is what he's talking about is the Lebanese going into new kinds of ventures. They're no longer waiting to import everything from abroad, but now starting to use their own their own brains to actually evolve new methods, new products, and to supply the market, and in a country that's totally devastated. I think if you can pick the right sector and the right person to run with it, I think you could make a hell of a lot of money. That's my own view.
Great. That's all the questions we have for today.
Thank you, Lisa. Thank you very much. Thank you very much for all for attending this, and please watch your websites for future events. I think there could be some exciting events coming up. In 2 weeks' time is Lebanon's National Day, and thereafter, I think we may also be holding some. We are busy trying to plan some events that will be of great interest to members and future webinars. We would love to engage with local Lebanese entrepreneurs and see how they, what their ideas might be. And of course, above all, we would really like to have some ideas on how to promote trade and investment in both directions between Lebanon and South Africa, because that is, after all, the main rationale of having a Chamber of Commerce. But other than, of course, to assist in providing interaction and networking between the Lebanese in South Africa. Mark and Greg, thank you so much for your contributions. They were very valuable. And to the ambassador as well for updating us on Lebanon. And I would wish you all well. Just keep an eye on your websites for future events. Thank you very much all for attending and for your support.